So with the new year just around the corner, should investors expect more record highs in 2026? Let's ask Steve Sosnick. He's the chief strategist at Interactive Brokers. First of all, welcome to you.
Great to see you, Kelly.
Well, I mean, you get kind of a front row seat into what's going on your platform. All the retail interest, the stocks people are chasing, the market that they may or may not be chasing. What do you see and what does that tell you about what next year may hold?
Well, it seems like the momentum stocks that have got us here still remain in favor with our customers. They're buying on balance on any given week of our 25 most active stocks. We'll see 22 to 25 net buys as opposed to sells. So there's clearly a pattern of money continuing to flow in. The ones that are most active should not come as a huge surprise. It's Tesla, it's Nvidia. Lately, it's been Micron because of the great earnings. It's been Oracle because we can't read the news without talking about them. It's been Broadcom. Other ones that come in and out, Palantir gets up there. If we sat here, you could easily get 10 of the 25 within about 10 seconds.
And what does that tell you? I mean, at a time when a lot of people are talking about whether AI is in a bubble, is the rally broadening or not? What's going on with retail participants? I mean, everyone's back at work now, but I guess we're all still trading stocks more so than we were 5 years ago.
Yeah, well, our customer base tends to be a bit more what I would call pro-tail in some regards. They're a bit more sort of focused on the markets, more day to day. We don't necessarily cater to as many casual investors. We have plenty of them, but we also have what I would call a lot of semi-professional investors, individuals who use, who basically, if not at their full-time job, but they use very sophisticated strategies. They're smart. And to be fair, let's say in April, they bought big.
I remember you saying that.
In November, they kind of were a little bit early, sold a little bit before the market faded and then came back in. They've been very aggressive at buying dips. One thing I think we've seen, and it'll be interesting to see, how long this persists, is dip buying remains probably the number one most popular strategy. And to be fair, it works. Now, nothing works forever. Trees don't grow to the sky, et cetera, et cetera. But it's worked so well for so long that I can't. Why should they stop?
I think that's what's keeping afloat. I've seen other analysts like Brian Reynolds say that retail interest is literally now as big a factor in the market as stock buybacks, which for years in the 2010s, we talked about how stock buybacks were constantly supporting equities. Do you think that retail participation is kind of keeping a floor under the market as well? Absolutely.
I think that certainly was the case in April, let's say, when institutions were freaking out and individuals continued to buy. I think at some level, the institutions have adapted too, because I think so many of us have become momentum traders. So, as long as as long as the trend remains intact, it's understandably why you'd want to buy the dip. If that trend breaks, buy the dip doesn't work so well. But as of now, the trends have remained in place.
If you know you're going to make money, and I'm saying this kind of tongue in cheek, why not leverage it up? I mean, do you see that those kind of phenomena? I mean, anything that you would describe as maybe getting a little overextended or no?
In any given week, TQQQ, triple levered QQQ, is more active than QQQ.
Yeah.
It's uncanny. So they're both among the most active names on our platform, as you would expect. But I think it is a little counterintuitive for people to realize that TQQQ outpaces QQQ. TSLL, the double levered Tesla, never really has threatened Tesla's tops. Tesla's always number one or number two. But it's frequently in the top. It's almost always in the top 25 as well, because people like that leverage. And so, yes, if you like it at 1x,
you'll love it at 3.
Exactly.